Okay, so Seagate and Western Digital controls 90% of market share. Why? Okay, because after decades of consolidation, there's only three players left. Okay, Seagate, Western Digital, and Toshiba. So as mentioned, the first two companies, they roughly equal split of 90% worldwide market share. Okay, so we're talking about worldwide market share. It's not just about US alone. Even Samsung, which is a formidable competitor in technology, also sold its division in 2011 because it just lacks critical mass. Today, the capex is actually lower than depreciation and amortization, so free cash flow is higher than net income. This high free cash flow actually enabled Seagate to retire one-third of its outstanding shares since January 2010. So in 4 years, they managed to repurchase one-third of the outstanding shares. And in the meantime, they still managed to fund 1 billion dividend payout. Today, Seagate trades at around 10 times PE, Western Digital at 12 times PE. So these are very attractive valuations in our opinion. Both companies also have low debt and decent 12% margins. Investors, yes, they are rightfully concerned that PC market is shrinking, but it's expected to stay around these levels, current numbers, for the next 4 to 5 years. And also there's few job scopes that can function entirely on tablets. At best, they are complementary. I mean, you just think about it. How many people go about their daily routine without even touching a desktop at their work? Furthermore, non-PC sources account for as much as 50% overall revenue, particularly Western Digital, which they disclose. These non-PC sources refer to like DVRs, refer to your gaming consoles, refer to enterprise solutions as well, such as your cloud storage. So in this case, the Dropbox, we have a comparison. They offer first 16 GB free, then 100 GB for $10 per month. Okay, but if you talk about hard disk drive, you can actually buy a 1 terabyte for $70. So that's a 7-month payback and 10 times the storage. So actually, in fact, cloud storage really competes on data mobility and less of the price. In any case, this data has to be stored somewhere. Just a very quick, for cloud storage, right, they actually have to reduce the redundancy, they actually have to replicate this data 3 or 4 times on servers around the world. So you're actually generating a lot more information and data rather than less. Lastly, hard disk drive is the only game in town that has sufficient capacity to store the explosive growth. This data is growing at around 30-40% every year. So for perspective, 2012, 900 million terabyte data was generated, 3 times the capacity that was shipped. Okay, no other technology, not even flash memory, comes any close to this amount. SSD, solid state drive, is arguably a more superior technology. You do have moving parts, you have lighter weight, lower power consumption, etc. They use a NAND flash memory, but still they are 7 times more costly per gigabyte storage compared to hard disk drive. Seagate and Western Digital have also since launched hybrid drives. They combine the traditional SSD strengths with the lower HDD cost to bridge the gap in the meantime. Okay, next, according to a study, 400 plus million terabyte of HDD memory was shipped out in 2013, compared this to only 1/10 of the flash memory shipment, and of which only 16%, which is roughly 6 to 7 million terabyte, goes to SSD. So right now, the SSD capacity is only 1.5% of HDD, and there are some people who they did some calculations. They estimated that even if you invest hundreds of billions of dollars in flash memory investment to build up the capacity, you can only replace around 20% of HDD. Okay, so furthermore, unlike the HDD industry, which is effectively duopoly, Seagate and Western Digital controls 90% of the worldwide market share. SSD is very fragmented. We have actually more than 20 players. Samsung, SanDisk, Micron, even Seagate and Western Digital, they are competitors in SSD as well. There are no clear technology or price leaders in SSD industry. So we just look at how Seagate and Western Digital. Seagate is slightly lower market cap, 3.4% dividend yield, and from the price chart, it's also underperforming Western Digital, even though most of the time they are tracking each other's performance. So just give a one-pager on both Seagate and Western Digital and what's the investment thesis. For Seagate, they are very excellent capital allocators. But in the last 4 years, they actually repurchased 277 million shares at average price of $25 per share. Today's market price is $50 per share, so this is actually quite a lot of shareholders' value generated. Next, the free cash flow funded buybacks and also additional $1 billion dividend. All this on negligible increase in leverage. Okay, balance sheet is relatively clean because they impaired all goodwill attributable to its hard disk drive division in 2009. So there's no longer any more issues of legacy problems remaining from past acquisitions. It's also trading at 10 times forward PE, comparatively lower valuation than Western Digital. Lastly, the balance sheet again is clean and healthy, $2 billion cash. Net debt is only equivalent of 1 times net income. Okay, so we actually think that this is very manageable considering the amount of high cash flow that they generate. Next debt maturity is in 2.5 years' time in October 2016, so we don't foresee any liquidity or solvency issues. Western Digital, in the same time frame, they spent around $6 billion to purchase 3 companies. Okay, so the amount they can return to shareholders is relatively lower, $1.7 billion. Unfortunately, acquisitions, they have yet to translate into significant earnings boost, but their products actually score higher on performance versus Seagate's. R&D is also higher at 10% revenue versus 8% at Seagate. So their balance sheet net cash position, so they can actually take on more debt or repurchase shares to take advantage of the low valuation of 12 times PE. So in summary, these two companies both have their investment rates. We actually we have high preference for Seagate. We favor Seagate because of the aggressive share repurchases at today's low valuations. So EPS was able to rapidly compound for up 50% since 2010, even though earnings stayed relatively flat. Moreover, it's trading at a lower valuations of 10 times PE. On the other hand, Western Digital is channeling its free cash flow into acquisitions, so it's diversifying revenue base and products averages scored higher consistently than Seagate. So we think that investors who are willing to forego near-term capital allocation, near-term buybacks for lower long-term growth, they might actually prefer Western Digital as well. Okay, because there's only effectively 2 pure plays and 3 players in the hard disk drive industry, so there's a lack of comparables to reference valuations. What we did, we just give very quick back of the envelope. We factor in expansion of forward PE multiple 11 times at Seagate and compounded EPS growth from share repurchase. So okay, so we arrive at a fair value of $57.62. Just ignore the slight typo error. So this is a capital gain of 13.5%. Okay, so this 59.24 is actually factoring in the dividend as well. For Western Digital, we are optimistic that its acquisitions will bear fruit next year. So the fair value is $96, market price $88, and you have a capital gain of 9.2%. All right. So next, I'll passing on to my colleague Benjamin.
Right, good morning everyone. My name is Benjamin, and is covering the financials. So today I'll be bringing you through our take on the banking sector. So last time I presented was at the end of December, which we gave our estimates on how 4Q 2013 might roll out. So today, these are some of the key agendas we'll be going through. So a recap on how FY13 has rolled out for the banking sector. And next up, which is really the key focus area for today's presentation. Right, so a feedback that we got is that the banking sector is something that many investors do not really understand, right? And but potentially, this is a sector I think these counters are something that we can look at to adding to our portfolio, right? Although it's really pretty expensive, but with the reduction in board lot sizes coming up, right, and the rising interest rate environment and improving global sentiment rates, it's counters that we should look at adding to our portfolio. Right, so I'll bring you through on what are some of the key matrices that will help you, right, to look at and analyze the financials for the banks, right? So this is something they can share with your clients and use it for yourself as well. Okay, next up, what are some of the key areas that we think the market will focus on for the sector in FY14? Right, last up, the reiteration of our call and another bonus slide later on. So first up, a quick look at the price snapshots of the 3 banks. Right, so for DBS, OCBC and UOB, we have seen quite a massive sell down at the end of January. Right, ever since the results release, DBS has crept up a couple of percentage points over the last week. Right, for OCBC, right, similar trend as well. And over this portion, right, this is when they have announced their potential acquisition during Hang Bank. This is when the share price took a big hit. Right, and after the earnings release, which are the results for 4Q actually beat quite a bit of the consensus estimates, right? You can see the share price has been moving up quite a bit. Whereas for UOB, right, they have shown very, very strong growth for the bottom line for FY13. All right, so for the last week, the share price crept up about 5%. All right, moving on to the results review on DBS, right, so these are the major components that's been driving their bottom line over the last 1 year. So year-on-year adjusted income is 4.2% growth. All right, this is excluding one-time gains, which they disposed 450 million in FY12 of their stake in Bank of Philippine Islands. This year, they dumped away the remaining stake that they hold, which came out of 447 million. So we split into 2 tranches. First tranche is 221 million, right, which was recorded in FY13, and the remaining amount will be recorded in this current quarter. So for the net interest income has shown very, very strong growth, right? This is underpinned by the strong loans growth of 18% year-on-year, right? So it's a very, very commendable set of results, right? The net interest margins remain flat and was down year-on-year, right? But that's really because of the low interest rate environment that we are seeing, all right? So, but for the last time around when we made our call, we did state that the net interest margin should remain stable, which is what we see. And in fact, it has crawled up 1 basis point in the last quarter. Right, so this is what's been driving the strong growth in the net interest income. Right, fees and commissions, something that we have always emphasized on, that the banks are focusing on, right, as they evolve their business model into some bank that's going after wealth management, as well as the business bank portion, which is the trade finance business. So this is really what's driving the fees and income, showing double-digit growth. Right, non-interest income, DBS has performed surprisingly well despite macro headwinds. Right, so their trading income actually was all right, but not fantastic, right? So this is a very volatile item, right, that we remain quite cautious on. But what's the positive key takeaway is that their customer as well as their treasury flows is very, very strong. Right? So it provides a base support, right, for their non-interest income, right, for DBS. So for operating expenses, cost to income ratios actually dropped 1% year-on-year. Okay, so they're managing their costs quite well, but so the increase in operating expenses is quite in line with the top line growth. Provisions, DBS is more conservative. General provisions has went up in line with the big loans growth. Right, so this results in an improvement of 4.2% year-on-year. Right, moving on to OCBC, which is our least preferred bank during our last call. So you can see year-on-year took a hit of minus 2.1% on the bottom line. Right, this is really coming from their subsidiary, the Great Eastern Insurance, right, on the exposure to market movements. So first up, for their core banking operations, it remains strong. Net interest income, right, grew on the back of strong loans growth of 18% as well. And similar to DBS, their net interest margins remain stable over the last year, despite being very low. Again, this is because of a very low interest rate environment. So for fees and commission, right, OCBC has been showing very strong traction in this area. Wealth management fees are coming in strong from the Bank of Singapore, and the bank assurance model remains very robust, right? So it provides a very, very good distribution channel for wealth management as well as treasury products, right? And then for the non-interest income, this is the portion which we don't like OCBC for, right? So the trading income took some hits. That's really because of the macro environment, and as well as the Great Eastern portion. So what happens is that during June, when the market was anticipating the tapering of the quantitative easing from the US Fed, that's when the interest rate, long-term interest rates shot up, right? So we discount back the present value. That's why we get the hits from the mark-to-markets for the non-participating funds for Great Eastern. So that's when it took a hit. Similarly, in December, when the US Fed announced that they'll be commencing QE tapering in January, that's when interest rates move up again, and that's when they took a hit another time. So this is really why we don't like OCBC, because of the volatility impact on the bottom line. Right, operating expenses grew in line with the top line growth, and for provisions, not much changes. That's because their non-performing ratio remains the lowest compared to its peers, coming about 0.7%. We think that this low level of NPL might not really be sustainable. So the normalized amount should be around 1%. So we estimate that this should really creep up in this coming year. Right. So overall, a 2.1% decrease year on year. OCBC has shown, UOB has shown a very, very strong set of results, right? Growing 7.4%. Net interest income has increased quite a lot, right? The loans growth is about 16.8% year on year, right? And the net interest margins is actually higher compared to its peers, about 1.74%. Right, so UOB is a bank that goes after higher yielding loans and giving up a bit on the loans volume portion. Right. So fees and commission. Just to reiterate what we have presented the last time round, which we like UOB very much for its resilient fees and commission income. Right, so their loans-related, wealth management, as well as trade-related fees, shown very strong growth over the past year. Right, it's 25.8% growth over 1 year, very, very commendable and excellent set of results. Non-interest income took a hit, right, from trading income as well. Right, this to be expected in line with its peers. So one of the key positives we took away is that this area is something that the banks will no longer focus on, right, because of its high risk and volatility. So they'll be concentrating more on the flows from the customer for this portion. So OPEX as well, increase in line with revenue, cost to income, not much changes, managing their costs very well, and provisions in line with loans growth. Right, so that's about it for the results for the three banks. And a quick show of how the dividends have been. So for DBS, 2 cents higher than prior year, OCBC 1 cent higher, and UOB full year dividend, say 5 cents. They actually issued a special dividend of 5 cents, and they raised their base dividend to 50 cents. Right, so UOB's current dividend yield is the highest, coming in at 3.8%. And surprisingly, the three banks have reinstated their scrip dividend scheme. DBS and UOB have not stated what's the discount to the share price when this scheme kicks in. So for OCBC, they've said there will be a 10% discount to the share price during the issue period. All right. So next up, this part will be more interesting, I hope, for you guys. Is really what are the more simplistic key areas that we can use to evaluate the bank's performance. So something to share with you guys, and something you can use for yourself as well. Right. So if you remember the waterfall chart, some of the key drivers that we have, first up will definitely be the net interest income. Right. This constitutes about 50%, 60% of the bank's total income. Right. So this is a key area that we look at. Right. So the net interest income is simply the interest income minus your interest expense. Right, so basically what you loan out against what deposits you receive. Right, so the yields, what you get from your loans, and this is your funding cost, the cost that you incur upon the deposits that you receive in the most simplistic sense. Right, so your cost and use is definitely affected by the external interest rate environment. Right, and this is one of the key indicators we look at, the net interest margins, or NIMs in short, right, which is the net interest income divided by your interest-bearing loans. All right, so this is really somewhat like a measure of your returns of your assets. Okay. So what drives your net interest income? Right. So remember again, loans growth is a key portion, as well as your NIMs. So we look at the loans growth. The three banks have been showing very good, strong growth in last year. All right, especially DBS. Right. This is why DBS remains our favorite bank. All right, and then if you look at the net interest margins, which is affected by the external interest rate environment, it's been driven down a lot in the last few years, right, because of a depressed interest rate environment, right? So what we said that the last time around is that the net interest margins is expected to remain very, very stable, right? So this is what we have seen. This confirms our estimates, and in fact, it has crept up 1 to 3 basis points, right, over the last quarter, right? So even with a depressed net interest margin, right, the strong loans growth has helped to drive up the net interest income for the three banks. Okay, so this is one of the two key areas we look at for net interest income. So as you can see, DBS has outperformed its two peers, right, in terms of the absolute net interest income. Right, so basically this is about it for net interest income. All right, so what we use to as a proxy for the interest rate movement, which ultimately affects the net interest margins, is we just take a look at the SGD swap curve. All right, so during 1st Jan 2013, all right, the start of the year, this is the yield curve. All right, so at the end of the year, all right, just look at the red line. The yield curve has steepened so much, right, in terms of long-term interest rates. So what we expect is that the banks will be able to take some advantage of the difference, right, between the short-term and long-term interest rates, and this should help to improve their net interest income. Right, so this is what we use to evaluate the interest rate environment. If you look at the short-term wise, right, unfortunately there's not much movements, not much up creep for the short-term interest rates, and we don't expect this to change much until the midterm. But that's when we expect the net interest margins to recover. right? So the interest rate is expected to stay low for the short-term wise for the next 1 year or so. All right. So this ultimately impacts the net interest margins, right? Because the duration of the loans books for the banks are generally very short in nature. So this is really what affects the net interest margins for the banks, right? So moving on to the key components of the loans growth that you guys can focus on, right? So the banks are actually pushing on to the trade finance business, right? So for the DBS, you can see that they've been growing aggressively for their general commerce, which is the trade loans, okay? Yeah, similarly for OCBC and UOB, that's what they've been trying to do as well, right? And we see some uptick on OCBC for that over the last quarter, right? And this area refers to the wealth management portion, right? So you can see the upward trend as well for these three banks, right? So these two are the key areas that banks are focusing on. So if we look at the USD loans remain quite a good proxy to the trade loans, right? Because most of the trade loans are USD denominated trade loans, right? So what happens is that the banks are seeking after, for OCBC as well as DBS, they are tapping into the trade flow from China into ASEAN. So what happens is that China companies find it very expensive to borrow in China, so they get out of China, they go offshore to finance for any form of international trade, right? So they borrow in USD, which is cheap, right? So if you look at this red column here, this is DBS. You can see that the USD loans have been increasing so much, and that's in line with the trade loans, right? So something to note, this is the loans to deposit ratio, which is the loans divided by your deposits. It's been coming down in the last 2 quarters. So just keep this in mind as I will show you how the deposits are like later on. Okay. So the last part of the loans book, which we really focus on, will be the housing loans. All right, this is something that's very applicable to all of us. Okay, so these are the systemic housing loans that we have from MAS. Right, so with the cooling measures in place, you can see that the rate of growth has come down quite a lot in the last few quarters. Right, so what we know that is that the mortgage origins have come down about 30 to 40%. So we expect this trend to go down and possibly breaking to the negative region. Right, so even with the new exemptions that's coming in place for the TDSR rules kicking in, right, we don't expect this to drive out any form of loan volumes for the mortgage books, right, because this is not going to affect the volume of mortgage loans. But instead, what we expect is that there might be some competition in terms of competing for the refinancing of these existing loans, right? So this is something that we need to see how rational the banks are in pricing this refinancing of the existing loans when it kicks in. All right, and something that the bank's management have provided is that they expect to see a 10 to 15% correction in property prices, and through their stress testing, they have mostly reiterated that their mortgage book, right, can take up to about 30% decrease in housing loan price and housing prices. All right, so this is something that they have guided for. Right, so 3 key portions for loans, housing loans that we can look at, which constitute about 25 to 28% of their total loans. And the 2 areas that they are growing will be the trade finance, which is the general commerce, as well as their wealth management loans. Okay, so that's about it for the loans and interest income portion. So now we move on to the part which is driving the cost, which is your deposits. So with the potential rise in interest rates, right? So this will definitely be come in terms of funding pressure as well, because if your interest rates go up, you might earn more, but your funding will increase. Funding costs will increase as well. So what we see is that the 3 banks are trying to build up their deposit base, right? So you can see for DBS and OCBC aggressively growing their deposit base. So remember the blue line that I showed you, which is the loans to deposit ratio. This is the USD deposit. So with the increase in USD loans, right, you can see that the 3 banks, right, especially DBS, right, is gearing up on their USD deposits, right, growing the deposit base for USD to match off against their USD loans, right. And DBS remains our favorite bank, right, because of its high current accounts and saving accounts balances. So these are basically what we put in the bank, right, all of us. So this is relatively sticky, and because it's not something that we just withdraw money and throw into another bank, and so it remains a very cheap source of funding for the banks, right? So DBS has the cheapest source of funding in a sense, right? Because they are high CASA balances. In the fixed deposit space, this is very competitive. Okay? Whichever banks gives you the higher rate, you just put it there, right? So we can see there's a bit of competition for fixed deposits in the last quarter, right? as the fixed deposit ratio has went up quite a bit, right? And UOB remains the highest on their fixed deposit ratio. All right. Beyond this, right, loans deposit used to be a very traditional measure of how much liquidity you have, as well as how efficient you're using your deposit base, right, to give out loans. So here's loans against your deposit, how much deposit you receive, and how much you can loan out. All right. So traditionally, this used to be a measure, right, for these two key indicators. But currently, with the increase in trade loans, like I mentioned just now, there are other ways to fund your loans instead of just using deposits. So what the banks are doing is they're turning to the wholesale market, going to the commercial paper market, and going there to borrow, because substantially the cost doesn't change much. It's not much difference from taking deposits, and it provides a better matching of the duration of the loans. So if I want to give out a 3-month trade loan, I can go out and borrow, issue a 3-month commercial paper, provides a much better duration matching, right, asset duration matching. Okay, that is why the loan book is such a short duration, right? And that is why we say that the net interest margins are really very much impacted by the short-term interest rates. All right, so that is really about it for the net interest income portion. Hope this sheds more light for you guys. So with your loans growth, your interest rate environment, as well as your deposits. Okay. So next up, this fees and commission remains a very key driver for their top line and bottom line, right? Fees and commission is something that goes hand in hand with their strategy of going into a wealth management and trade finance banks for the 3 banks. Okay, so this relatively asset light, right, and capital light, right? So you can see shown very strong growth for the 3 banks, right? Been growing quite well, and UOB is showing much more resilient fees and commission income. All right. So these are the 3 areas that I mentioned just now: trade-related, wealth management, and loans-related. So you can see for OCBC, their wealth management fees, right, been growing very strongly. That's because of their Bank of Singapore. The AUM is growing well, and that's where they're earning. And it forms a very good distribution channel, right, for their wealth management and insurance products. For DBS, this is coming from DBS Hong Kong, the trade loans, and that's when they can earn not only on the interest income, but also on the fees that they have for the trade-related loans. Right, and they're growing the AUM as well. That's where they're earning their wealth management fees. For UOB, their loans related is a bit lumpy, okay, but it's growing very strongly. Right? Investment related, which is wealth management, and their trade related fees. Okay, so these are 3 areas that the banks look at to grow. So it's something that you can look out for the next time around. So for the non-interest income portion, right, this sometimes makes or break the bottom line for a bank. Something that we really don't like, right, because it remains a wild card, a very volatile item. Right, depending on the market movements, right? So for DBS, right, there's quite a bit of growth, right? That's because of their treasury flows, right, which gives them a constant stream of income, right? So UOB is the least exposed, right, in terms of market related movements, and that's why we always say that UOB is the most resilient in terms of earnings. For OCBC, it's very volatile, okay, coming from the insurance arm, right, which is why we don't like them. Okay. So if we look at the business segment split, right, it gives us a very rough gauge of how is it like. So for DBS, we look at the treasury portion, right, showing stable returns, right. Again, coming from the customer flows, okay, and their treasury products. So for UOB, they've been trimming down on this portion, right. So they're no longer focusing on the trading arm side of the bank, right. So for OCBC, you can see how much they're exposed to market movements and market volatility. Right, so for insurance, you can see it's up, down, okay. So that's why it's impacting their bottom line, right? So the earnings volatility is something that we don't like, and I don't think investors will want that as well. So really the last bit that we look at to have a feel of how the banks are going towards is looking at their geographical portion. So you can see for DBS, right, the Hong Kong and Greater China arm is doing very well, right? This is where they're tapping on to wealth management fees, as well as the trade-related business. So UOB, largely most of the revenue is booked here in Singapore, okay, but they still remain quite a bit diversified across the ASEAN region. Okay, so this is a portion that we remain a bit cautious on Thailand. For OCBC, their Malaysia is showing very strong growth, right, from their Takaful as well as their Islamic banking business. Okay, but they still remain quite exposed to ASEAN, right? So ASEAN is a region we are more cautious upon, right? So we want to exercise some caution on OCBC. So for OCBC, right, so this is the portion they're trying to grow, Greater China. That's why they want to buy over Wing Hang Bank. Okay, so that's about it. I hope that helps you to know what are some of the key matrices that we look at when we look at the banks. Okay, so these are the key areas that we think the investors in market will focus on for FY14. So for net interest margins, it's estimated to be quite stable over the next year with little changes. Okay, just to re-emphasize, that's because short-term interest rates are not expected to move up much. Okay, so the downside risk that we see is that if the funding cost goes up, this might create some pressure on your net interest margins. So for loans growth, it's coming from a very high base of double-digit growth the last year. So we think that this will moderate down to high single-digit, right, to maybe the low teens areas. Okay, this will be coming from the regional growth that the banks are seeking. As the Singapore market is very, very saturated, where there's really not much room anymore for loans growth. Right? You can see that housing loans is going to kick in. The decrease in housing loans is going to kick in once the drawdowns of the previous batch of loans start to end. Okay, fees and commission, this will really be the key area that the banks are looking at. Okay, so they expect double-digit growth, and we expect the traction to continue in this direction. All right, this will provide very strong support, right, for their top line. Okay, in case that there's some pressure on the net interest margins. So for costs, okay, the banks are spending more money, right, to expand overseas. So we expect the cost of income to tick up quite a bit, maybe a couple of percentage points, right? So and the staff cost is expected to increase as well, right, once the new revised contribution to CPF of additional 1% comes in. Right, asset quality, which is the risk on your loan book, where we expect it to be still intact. Not much changes to non-performing loans as the interest rate environment remains low, and the bulk of their loans is actually trade loans, which is very, very short in nature. So we don't expect any worsening of credit quality. Right, and in terms of regulatory changes, the last time around we said that MAS is rolling out this new measure called the liquidity coverage ratio, which comes under Basel III. So this will be a key focus area that the banks and I think investors should look at, right, once it rolls out, to measure your liquidity instead of using the loans to deposit ratio. Right, so loans to deposit ratio is not a very good measure, right, because a lot of the funding is coming from commercial paper now, right, instead of deposits for your loans. So on the ASEAN and China front, we remain a bit cautious, right? For ASEAN, Thailand is not really easing off on their political political scene, right? China is a bit unpredictable on their data as well. So we think this might affect some of the overseas subsidiaries, right? As well as be cautious on any depreciation in the ASEAN currencies. So that's about it for the banking sector. Okay. So just to reiterate our call, DBS revised, all three banks revised target price slightly downwards, right, to reflect the sentiments that we have. So these are the three target prices. The calls remain the same. DBS and UOB still accumulate, and OCBC is a neutral. So we remain a bit cautious on OCBC again. The Wing Hang Bank still an overhang on the share price. And last Friday, they just announced that they are extending their exclusivity agreement with Wing Hang Bank to negotiate the price, right, till the end of March. Okay, so this is a key area that we think the market will focus on for OCBC. So in terms of valuation, DBS still remains the most attractive, right, undemanding valuation. The PB ratio is lower than its peers despite the strong growth in their ROE profile. Okay, so that's it for the Singapore banking sector. Hope this helps you in any future analysis that you want to go through, okay, with your clients or yourself for the Singapore banks. So last up, just a quick one-slider, okay, on SGX. So SGX in the last quarter, okay, which is they announced their results at the end of January. So it's a weak set of results, right, but slightly beat our expectations. So the weak set of results is really very, very seasonal. The last quarter of the calendar year, January sees very low trading activity, as well as coupled with the penny stock saga, okay, which I'm sure you guys are very familiar with. They've taken a hit on the the securities daily average value. So SDAV for Singapore still very weak, coming about 1B in average. Okay, so it's almost at an all-time low. Right, that's why their securities clearing revenue has not been very outstanding. Okay, but a key takeaway that we have is the derivatives volume and revenue, which is something that we have always reiterated on, that this will drive their top line and bottom line. It's growing very, very well. All right, so this is a key focus area that we should look at. right, as the securities and derivatives revenue, right, have the proportion wise is currently on equal, about 30%, right? Compared to prior year, it's about coming about 28% against 38%. Okay, so the key area we want to emphasize is the new regulatory measures that have been proposed, right? So if you're following the news, I think you guys should know that MAS and SGX have come together for a consultation paper, right? And they are proposing that there's a minimum trading price should be implemented, right, for the main board listed companies, and minimum collateral in place, T+3 clearing to T+2, right, to clamp down on contra trading, right. So we think that this might potentially worsen some volume in the short run, right. This might drive away some of the retail investors, right. But overall, I think this will help to promote a much healthier and transparent marketplace. All right. So in the medium term, I think that this is something that's very positive for the market. And I think retail investors should look forward to that. On top of that, the fees have also been revised. Used to be 4 basis points for retail investors, i.e. contract values below 1.5 million. And now it's cut down to 3.25 basis points. All right, so it's a 19% decrease in trading in the clearing fee. And for the cap trades, which is above 1.5 million contract value, which we usually refer to as the institutional trade sizes, right? Used to be a cap of $600 a day. Now it's also revised to 3.25 basis points. All right. So based on our sensitivity analysis, this is using the full calendar FY13 trade data. Right. If the trade volumes hadn't changed with the revision in fee structure, we expect it would have been a 6% increase in the securities trading revenue. All right, clearing revenue. Okay. So in a short run, if there's a decrease in the retail trade volume, right, overall it shouldn't have much impact on the revenue. But however, if you look at this portion, if the retail volume does pick up, right, from the improved market situation, where we expect to see more than 10% increase in securities clearing revenue. Right, and currently, if you look at the valuations, it's very, very undemanding, right? As SGX is trading a 5-year PE is below the 1 standard deviation, right? So currently, SGX is very, very undervalued. And it's something that I think we can look at, right, as a proxy to any STI recovery or movements. All right, so with this, I end off my presentation today. All right, so you might start asking any questions that you might have. Thank you.
Hi. Okay. We have one question. Okay. First question is: does the iPad contain HDD inside? No, iPad doesn't. iPad contains flash memory. So the thing is that this is what we're talking about. Tablets. This PC is one that has the HDD, whereas tablets has the flash memory. And then people are talking about, oh, is the tablet going to replace PC? And my argument is no, because on a daily routine, it's very hard not to use a PC, not to use a desktop. Okay, next question. What is Seagate? Seagate is one of the 2 hard disk drive manufacturers that controls 90% of the worldwide market share. Okay, third, usually how much does a HDD cost in a computer in terms of percentage? Okay, from what we know, every unit of HDD that Seagate and Western Digital ships out, they are selling it for about $60. So for PC, the memory is around 500 GB or 1 TB.
Okay, I've got quite a couple of questions on the banking sector. So first one is how does the OCBC eyeing a all Hong Kong family-owned bank a good move or not? But this is really a very much contested point, right? That we have across the market. So Wing Hong Bank is like you said, it's a mid-sized family-owned bank, right? In terms of the business they take over, it's very much focused on retail business. So strategically, they are really buying the Hong Kong bank. I would say it's really for the branch network that it offers. Because currently OCBC only has one branch in Hong Kong. Right? So with the acquisition of this Wing Hong Bank, it provides them with a branch network that they require to expand their operations. Okay, so it's something that currently, but we're not sure how accretive it might be. Okay, in the long run, of course, it'll be positive. It's a very strategic move, right, to penetrate the Hong Kong market, to penetrate the Greater China market through Hong Kong. But as the China companies seek offshore financing, but in the short run wise, right, the financing that they require, right, for OCBC, okay, they might possibly need to, most likely will need to issue equity for it, right? So we will see some EPS dilution in terms of that as they raise some equity capital and maintain their capital ratios. Okay, and then the next one is why does OCBC share price don't reflect the selling of their holdings of F&N and Asia APAC Brewery? So I must emphasize that this event happened quite long ago in FY12. So the selling off of the F&N and APAC Brewery has really been priced in quite some time ago. All right. In terms of loan exposure of the three banks in China, right, the loan exposure wise, we can't be very certain on in terms of absolute amount what is the actual exposure, because the loan booking is something that's discretionary to the bank, right? So what happens is that the loan might originate from China, right, but they can book it in Singapore, right, depending on where the credit risk lies. Okay, so the loan might originate in Singapore, they classify it under China because the credit risk lies there. Right, so especially the USD RMB book. Okay, so the RMB, they don't really finance in RMB, just to re-emphasize, because it's controlled. Right, so the China companies are borrowing USD because it's cheap. So they come out of China, they go into Hong Kong, and they seek financing for any forms of international trade. Alright, so that is why so much of the trade loans, a bulk of the trade loans are actually in USD. Okay, net interest margins, that stands for, this is the long form for NIMs, right, net interest margins. How active are Japanese banks? Unfortunately, Japanese banks are not something that we cover. DBS Hong Kong is an incorporated entity in Hong Kong. Okay. Any reason that we see some weakness in DBS share price today? That is quite in line with the STI movement, right? Because DBS is very much affected by China. Any forms of China data, global data, right, will have an impact on the share price.
Okay, question. Okay. Question is, should I add more Sin Heng shares now that it's dropped a little to 0.97? Okay, I'll just take this time to tell you a little bit about Sin Heng. Okay, here's the thing about Sin Heng. Okay, right now, I will say that any price that makes the price to book value less than 1 is definitely worth collecting. So at 19.7 cents, right, the price to book value for Sin Heng is actually less than 1. Now, here's the reason why. Okay, first of all, remember that Sin Heng, it basically has a net cash position in terms of its net debt. I mean, it's okay, and that 90% of its PPE is actually in monetizable assets, which is cranes. Okay, so actually 90% of their assets are monetizable, and because Sin Heng is one of the premier crane traders in Southeast Asia, right? Hence their rental fleet is definitely monetizable. So hence I'll say that, and since you're buying at less than a price to book of 1, that implies that you're basically getting their trading networks for free, if you think about it. Because Sin Heng basically has a rental fleet, and then it has a distribution arm which sells in Southeast Asia, right? So if their rental fleet is already worth its market cap, then essentially you're getting a big giant discount on his distribution arm. So yes, I'll say at 19.7 cents you can accumulate Sin Heng shares.
All right, Lucas here. I'm just taking the questions on CapitaLand. First question, should I accumulate more of CapitaLand share and what is their NAV value? Okay, I shall answer the second question first because it's simply more easier, it's more factual. The NAV value right now is about between, I think it's about 3.8, 3.78 or 3.8. I think it's around there. I had to, I think it's 3.8, $3.80. After restatement of FRS 110, it will rise up to about 4.4, but I don't think that the NAV is actually the price to NAV or NAV value can only be so much indicative. The price is right now definitely below NAV value or net asset value, or what they call it, the book value. You should more look at the RNAV after you revise, look at the potential upside for their projects and whatnot. So the price to RNAV value is currently about 40% discount based on current the price of $2.87. I think that's more indicative of their true value. So you can look at it from that point of view. I think that will actually be more be better for as to how you guys are looking at it. Should I accumulate more of CapitaLand share? I think this is more of a timing issue. It also depends on what your clients are looking at. Having said that, definitely this is among the big three developers. This is one of the more heavily discounted one. The reason for the heavy discount is also firstly the management change. That guy is in his first year, he's unproven. Secondly, he's also going through some restructuring. They're trying to change everything to not say everything. They're change 2/3 of their assets to provide recurring income, and 1/3 to development, which is kind of like if you look at it from on a very historic kind of outlook, the development side of things has always provided the more lucrative business for them, but due to the current outlook, they are having this change in their fundamental and their views, and they're trying to make it more stable and whatnot. So going forward, you will not be able to see them reporting about those 18-19% returns on their projects. They'll be more looking at 8 to 12% for recurring. So is it really we are advocating a positive outlook, largely because of the fact that it's heavily undervalued, as in it's undepending valuations. Having said that, but the fundamental stays intact, and if these such returns actually satisfies your criteria for investment, then you should accumulate more of capital right now, as in since the downside is more or less priced in.
Sorry, Ken here. Back to the Sin question again. So the question is, what is their net asset value? The net asset value for Sin is roughly 21 cents. So I would say that any price below 21 cents is definitely worth accumulating. However, just to reiterate, for Sin, right, it's only for patient investors, because this year their earnings growth will not be fantastic. In fact, it could very easily be flat. And the reason is because this year is their regional expansion year. So they're investing more capex and into these areas, and more of the effect of their expansion will be seen next year. So that's when earnings growth will really come in. But at the same time, right, we are expecting an improvement in rental at the end of this year, second half of this year. So you should see an improvement towards the second end of this year in terms of earnings for rental. And the year after, that's when there should be more earnings growth due to their regional activities. So investors who Sin should probably take at least a year outlook on this. Okay. Well, yeah. I made an educated guess that there will probably be a meaningful correction towards May, and my current view is unchanged. So as I said, I expected to have a minor correction first, and that was in February, and that has happened. So I said February there'll be a correction, May there'll be a correction. So in between, obviously, the market should either go up or go flat, and so right now we're going up. So how I see the market now is, at least for the US side, and I think there'll be a correlation to the Singapore side. On the US side, I do results are mixed, but actually towards the positive. I do see like breadth indicators being not fantastic, but it's encouraging. Commodity prices have been going up. However, copper has been lagging, so that's also mixed, but it's not that bad. So what this tells me is that I think there's enough sentiment to slowly increase the index price. Okay, however, I do not think the price will be flying from here, and I still do think there'll be a correction later this year in May. But between now and May, I expect it to be either flat or slightly up.
Hi, Benjamin here. Reference back to the one of the questions. Right, so for the USD loan book for the three banks, just for FY, DBS and OCBC, proportion-wise about 26-27%, and for UOB, it's a bit low. It's about 12%. As I mentioned just now, UOB books their loans mostly in Singapore, right? So that's where we see the revenue is coming from. All right, I have a question on SGX. When is it going with the 100 share lot? Okay, the reduction in bot lot sizes. So during the last update that they gave was probably after the first quarter of this year, of this calendar year, when they'll implement, as they're setting up the infrastructure to take in the reduction in bot lot sizes. All right, in terms of volume-wise, of course, we do hope that the reduction in bot lot sizes helps to drive some volume, right? Coupled together with the decrease in the clearing fees from 4 basis points to 3.25 basis points, right? But we can be sure that liquidity in the market should improve with reduction in bot lot sizes, right? And just to reiterate, I think some of the big counters are what we can potentially look at to adding to our portfolio, right? Of course, I know that now with one bot lot size of 1,000, one UOB, buying UOB will cost you about 20 odd K, right? So with the reduction, let's see if we can hope there's more take up from retail investors on that. All right.
Hi, there's a question on Ezion. Fundamentally, Ezion is still a good play. Out of the 30 SEU contracts that they secured, only 17 are actually contributing right now. So there are 13 more to go. So the growth story still continues, and our target price for Ezion is at 257. With regards to Wilmar, our target price still remains at 388. One of the main reasons why we maintain our accumulate rating is because of the fact that we still see long-term fundamentals, which is sound for Wilmar itself. The oilseed and greens division is recovering. The palm and lauric division is also seeing robust earning despite the increase in the refining capacity over in Indonesia itself. And consumer products is also seeing strong growth in 4Q. As for the and the closing price last week for Wilmar is at 337. With with our target price of 388, it still has more than 10% upside, including dividend. That's why we remain accumulate for Wilmar itself. As we say for Ezion, there are still 13 more contracts out of the 30 contracts that they have secured. So there are still a lot of upside to go going forward.
Hi. Next question is it's Ken here, another market question. The question is, for the correction that you expect in the US market in May, do you see this as a major correction like some of the other speculators that there might be a crash this year? Okay, here's the thing, right? So I'm not sure which speculators you're referring to, but I did my thesis about the market. I think it was end of January. So you can look back at our archive webinars to see my thesis. I did a pretty long one. I think it was half an hour. But I'll summarize the thesis. Basically, I don't think there's going to be a crash. Technically we are still in a bull market. Economic indication as well as sector rotation as well as intermarket relationships imply that we actually are still in a bull market cycle. So because we're in a bull market cycle and because the yield curve is not inverted as yet, okay, in fact it's pretty steep. So that's actually a very healthy backdrop for a bull market. Because of that, right, I do not expect a crash. However, I do expect that the markets this year will end flat, flat or slightly negative. So that being said, yeah, so how big the correction will be is you should take reference from the beginning of the year what the level was, because I think the year should end flat. So if there is a correction, the correction will not, I repeat, the correction will not exceed 20%. Okay. The reason why is because I mean, please refer back to our to my presentation in end of January, okay, to know why it's less than 20%. Okay, question, Ken, are you going ahead with your course after the survey that you have done? Yeah, that's a good question. Right now, I guess we're trying to absorb you know, the comments and working out on manpower issues here to see whether we can have a course or not. So we'll definitely let you know if we're planning to do so. Okay, but we definitely will not be doing so in the first half of this year. That is most likely. Yeah, but thanks once again for all the survey replies. We really appreciate it. Thank you very much.
Oh, alright. Okay, I think that's all for this week's webinar. Hope you guys can tune in again next week, same time at 11:15.